Welcome to vTalkInsight, Allocator's Lens Daily for February 16, 2026. Cross-asset signals are diverging. Equities are wrestling with an AI-driven shakeout, defensive rotation, and geopolitical risk, while incoming data still point toward disinflation and a plausible soft landing. Bond markets are enjoying strong demand and pricing and rate cuts. Credit spreads remain tight, and commodities reflect a volatile mix of tariff policy and shifting energy alliances. Over the next few minutes, we will connect those dots from an allocator's perspective, starting with what the latest volatility says about global equities. In equities, the story has shifted from a clean, soft landing narrative to a messier blend of AI exuberance and risk aversion. Index levels still look benign, with the S&P 500 only a couple of percent below record highs, but beneath the surface the adjustment has been violent. Large-cap technology has seen more than $500 billion of value erased in a single day across 10 megacaps, with Amazon down about 18% and Apple off around 5% over a short window. That kind of drawdown is less about macro data and more about investors suddenly questioning how durable AI-driven spending plans and margins really are. At the same time, the market is rewarding a different set of AI beneficiaries. Semiconductor and equipment makers tied to AI infrastructure continue to deliver strong numbers, with firms such as Applied Materials and Arista guiding sales well ahead of expectations. AI-focused chip leaders like NVIDIA and Avago are still seeing robust earnings growth and positive estimate revisions, and many argue their valuations remain reasonable relative to those growth rates. Yet their heavy weight in major indices means any sustained weakness in this group would have outsized consequences for headline equity performance. Rotation is also clear at the sector level. Banks have fallen roughly 6%, while defensive consumer staples have pushed to record highs and outperformed the broader market by about 16% year-to-date, a pattern rarely seen outside years when the S&P suffers double-digit declines. Investors are pivoting toward real asset-heavy businesses, such as energy and staples that are perceived as less vulnerable to AI disruption, while logistics and trucking stocks have sold off sharply on even small pieces of AI-related news. The Russell 3000 trucking index, for example, dropped about 7% after a relatively modest platform update, underscoring how nervous the market has become. That nervousness is visible in market structure. Volatility has picked up, with roughly 30% of S&P constituents sitting at 8-week highs while 15% are at 8-week lows, and liquidity looks fragile as algorithmic trading and stop-loss activity amplify intraday swings. ETF and retail flows are no longer providing a strong buy-the-dip backstop, and speculative positions are being unwound across equities and even some traditional hedges. Offsetting this, leadership is broadening geographically, with Asian markets such as South Korea, Taiwan, and Japan benefiting from strong demand for AI infrastructure and chips, and European defense companies seeing multi-year order growth as governments ramp up spending. For an allocator, that mix means index-level signals understate the true dispersion risk, and attention is shifting from simple beta toward where AI, geopolitics, and balance sheet strength intersect. In rates, disinflation is meeting very strong demand for duration. Headline consumer prices slowed to about 2.4% year-over-year, down from 2.7%, with food at home barely rising and gasoline prices falling more than 3%. Shelter inflation, which had been a stubborn driver, is now decelerating as rental markets soften, increasing confidence that housing will put less upward pressure on the index. Treasury yields eased after the release, with the 10-year drifting lower and curves bull flattening not only in the United States, but also in Japan. Bond demand goes beyond a single data point. Recent 30-year Treasury auctions have seen exceptionally strong end-user participation, and high-quality corporate issuance has been met with similarly robust appetite. Many investors see fixed income as offering attractive yields today with the prospect of lower policy rates ahead, especially as the Federal Reserve's current rate still sits above most estimates of neutral, and the market price is roughly 2.5 cuts this year. UK gilts stand out as offering a sizable premium over domestic inflation and over other Group of 10 bonds, with some arguing that Bank of England easing is still underappreciated. The picture is not one way, though. Some analysts think official inflation measures understate reality, putting true year-on-year price growth closer to 3%, particularly in housing, childcare, and medical services, and goods inflation is seen as structurally higher than before. Steel and aluminum tariffs are another source of potential price pressure, and upside surprises on future prints could trigger a sharp move higher in yields, especially around the 10-year, where that risk is not fully reflected. Political scrutiny of Federal Reserve projects and delayed board nominations also add uncertainty around policy communication and leadership, which could matter if the data start to challenge the current benign narrative. Credit markets are sending a calmer signal than equities. U.S. high-yield spreads remain historically tight, helped by an improvement in the overall quality of public borrowers as weaker credits migrate into private markets. Investment-grade demand is very strong, with issues from large companies such as Alphabet being heavily subscribed, including deals in multiple currencies. That suggests global investors are keen to own corporate risk at current yield levels, even as equity volatility rises. Risk has not disappeared, it has shifted. Stress is building in leveraged loans and parts of private credit, particularly in software lending, where business models are more exposed to rate sensitivity and disruption. Returns in private credit have compressed from double-digit levels to the mid-single digits as capital has flooded in, making simpler fixed-income instruments, such as municipal bonds and high-quality corporates, look more competitive. So far, weakness in those private pockets has not spilled over meaningfully into public bond markets and is treated more as a tail scenario than a base case. This divergence between tight public spreads and more fragile segments is important for a cross-asset view. As long as investment-grade primary markets remain open and high-yield spreads stay contained, companies retain the ability to refinance and term out debt on reasonable terms. Coupled with expectations for at least a couple of Federal Reserve cuts and forecasts for solid, if unspectacular, GDP growth that underpins a constructive backdrop for credit even as equities reprice AI and geopolitical risks more abruptly. Key indicators to watch include any widening in high-yield or loan spreads, signs of contagion from software lending, and how a busier IPO calendar interacts with bond issuance in absorbing investor demand. In foreign exchange, the themes are de-risking in the short term and gradual diversification in the background. Broad unwinds of speculative positions have hit not only equities and precious metals, but also cryptocurrencies, a pattern consistent with investors trimming higher beta exposures as volatility rises. At the same time, structural shifts continue as reserve managers reduce reliance on U.S. Treasuries, adding to gold holdings and, in some cases, diversifying into other currencies. On the private side, large issuers such as Alphabet are tapping multiple currency markets, reinforcing the idea that the dollar is increasingly sharing funding duties with other majors. Trade tensions and technology rivalry between the United States and China are another driver, with ongoing scrutiny of firms like Alibaba reminding markets that political decisions can quickly alter the risk premium attached to certain countries or sectors. For allocators, currency risk is therefore ever more tied to policy and geopolitical developments rather than simply to interest rate differentials. Commodities round out the picture by tying geopolitics and inflation together. In precious metals, structural demand for gold remains robust as central banks and reserve managers diversify away from treasuries and as geopolitical tensions stay elevated. That long-term support has to coexist with episodes of forced selling, where investors liquidate gold to meet margin calls or cover short positions, which can temporarily mask the underlying bid, but do not necessarily change the strategic role of the asset. In energy, attention has turned to Venezuela, where new agreements are granting companies like Chevron and Repsol access to additional production areas. Officials talk about the potential for a 30 to 40% increase in output over the first year of renewed investment, which would be a meaningful boost to global supply if it materializes. However, the absence of formal security guarantees, the country's political volatility, and years of underinvestment mean that delivery risk is high, even as the United States uses this opening to reduce Chinese, Russian, and Iranian influence in the oil sector. Base metals face their own cross-currents. Tariffs on steel and aluminum have contributed to higher domestic prices and some stagflationary pressure. Yet there are now signals that U.S. policymakers may look to narrow or roll back parts of those levies, with aluminum prices already reacting to headlines. At the same time, Trends toward onshoring and resource processing in North America, together with the rapid build-out of European defense capacity, are supporting demand for industrial metals and specialized inputs such as rare earths and high-end chips. That combination suggests commodity prices will remain highly sensitive to policy announcements and defense-related procurement rather than tracking the growth cycle alone. Pulling all together, the cross-asset message is one of macro resilience colliding with micro and geopolitical stress. Equities are absorbing most of the adjustment, especially in crowded AI and mega-cap names, while rates and credit still reflect a relatively smooth disinflation and soft landing path. FX and commodities show that diversification away from the dollar and from treasuries is underway, with gold, multi-currency issuance, and new energy alliances all part of that story. For allocators, the key watch points are upcoming inflation releases, Federal Reserve communications, AI-related earnings guidance, and any escalation in trade or security tensions. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.